to my channel Accounts by Amrita. Hope you all are doing good. In the last video, we did some exercise questions for topic 1, bookkeeping in small business. So now we are ready to go to topic 2, taking stock of unit 11.1, single entry accounting. So let's begin. Inventory, or we commonly say it as stock, is initially valued at cost price, but if it has deteriorated or have lost some value and it cannot be sold even for cost price, then it should be valued at net realizable value, NRV, which is known as market value. It means that inventory is valued at cost price or NRV, whichever is lower. Now there are two different types of systems a business can use to account for inventory. Number one is perpetual. It keeps a continuous record of number of items of stock held by a business at any point in time, forming another subsystem. A subsidiary ledger will contain the individual files for each stock item, and the control account in the general ledger will be the inventory account. Periodic or physical. As the goods are purchased, it is recorded in the purchases account. There is no ongoing record kept of unsold stock. Stock is only counted and valued once a year at balance sheet date. Now there are a few methods of valuing the inventory. Number one, specific identification. This is the actual cost, also known as identifiable cost or specific cost. It is used when it is easy to identify the purchase price of each inventory item. For example, for a car dealer, it is very simple to identify the purchase price for a particular car. Then is first in, first out, FIFO. For valuation purposes, it is assumed that the first lot of purchases are the first sold out. And lastly, the weighted average cost, WAC. This third method involves averaging the cost of inventory every time a new purchase is made. The purchase price, the price basically is recalculated. So that's it for learning. Now let's do some exercise questions so that you could get some more clarity on the concepts. And alright everyone, we are going to do activity 2A. First we'll do it with FIFO method. So let's read the question. It says balance, they have given on 1st of April 500 at the rate 3, then on 6th purchases 300 at the rate 2.5, then 7 sales 600, 14 purchases 200 at the rate 3.5, then again on the same day sales 300 and 21st purchases 400 at the rate 2. So we have to calculate the value of an inventory as at 31st of April. So first we'll draw the pro forma, which is basically date, particulars, in, out, balance, and in, out, balance would have 3 columns in it, which is quantity, rate or cost, and total. So this is the pro forma that I have made for FIFO method. And so by balance brought down is 500 would go to balance, which is 500 3, and which comes to 1500 cost, total cost. Then purchases 300 at the rate 2.5. You'll write it in the in column 300, 2.5, it comes out to be 750. Then in the balance column, we'll not combine these two. We'll separately write 500 at the rate 3, 1500, and then 300 at the rate 2.5, 750. Then sales. 600 we have sold, but if we see, we have 500 at the rate 3 and 300 at the rate 2.5. So, and we are using FIFO method, so that means that the first that comes in goes out. So the balance of 500 at the rate 3 goes out completely, and out of 300 we sold 100 at the rate 2.5. So we have written out 500, 3, 1500, 100, 2.5, 250, and the balance remains just 200 at the rate 2.5, 500. Then we have purchases, 200 at the rate 3.5, again in column, and then balance. Then on 14th we have sales again. So basically we have just 200 units of 2.5 rate, so we'll use that, and then 100 units of 3.5 rate we'll use, so that it comes out to be 300 sales. And then there's purchases, 400 at rate 2. So basically the balance as of 30th April would be 100 at the rate 3.5, 350, and 400 at the rate 2, 800, meaning 500 units at the cost 1150. So have you guys understood how it's done? Now we'll do the WAC method, weighted average cost method. Now we are going to do the same question using the WAC method. So let's do. In WAC method, as you know, the cost price of the inventory is recalculated again and again. So let's see how much answer differs from that, from the one that we got in FIFO. So performa is the same, date, particulars, in, out, balance, and in these three columns, quantity, cost, and total column is there. So basically, the only difference is every time we make a purchase, we total the quantity and the cost and calculate the new cost price. That's all we have to do. So balance 500 at rate 3, we have written, total is 1500. Now purchases we have done 300, 2.5, which is 750. Now 300 plus 500 is 800 quantity, and cost is 750. The total actual cost is 750 plus 1500, 2250, and the new cost price would be 2250 divided by 800, which is 2.8125. Then sales has happened and 600 units have gone, and 600 units have gone at this cost, 2.8125. So these would always tally, the balance total and the sales total would always tally with the previous balance total. So this is how WAC method is done, and as we continue to do it, every time we are recalculating, whenever we are making a purchase, we are recalculating the cost price. So now we have 500 at final price, we have 500, 2.23125 at the cost, and the total cost is 1115.625, which is not that very far, because in FIFO we got 1150. So let's see how much is the difference. 1150 minus 1115.625, only 34.375 difference. So this is how WAC method we do. And the next question is same as this first question. We have to calculate the value of inventory using FIFO and WAC. Then question number 3 is also same. Question number 3 is your homework. Second, third, fourth, and question activity 2B and 2C are also your homework. Thank you guys for watching this video. Wait for the next video. Don't forget to like, share and subscribe. Till then, bye bye.